Okay, hi everyone, and welcome to the Marketplace Risk Virtual Event Series. My name's Andrea, and I'm the Director of Events and Logistics here at Marketplace Risk. Today, we're very excited to welcome Joe Hurley from Willis Towers Watson and Chris Moore from Apollo. Our virtual events are designed to help marketplace and sharing economy startups successfully navigate complex risk management, trust and safety, compliance, and legal subject matter so they can avoid distractions in order to focus on launching and growing. Be sure to check out marketplacerisk.com to access hundreds of hours of content, including our master's program, platform podcast, and previous live events, and to subscribe to our newsletter where we keep you up to date on everything, including our events, the Marketplace Risk Management Conference in San Francisco, and the Sharing Economy Global Summit in London. As we're gearing up for the conference in San Francisco on May 17th and 18th, we'd like to offer our virtual event attendees a discounted registration. Please use code VIRTUALEVENT50, all caps, at checkout for your 50% off. We hope to see you there. And thank you for tuning into today's session, Occupational Accident Insurance, Building Trust and Doing the Right Thing to Support the Gig Economy. A couple of housekeeping items. This webinar is being recorded, so the recording will be available for you to access on the Marketplace Risk website. Second, all attendees have listening capabilities only and are otherwise muted. And third, do submit your questions via the control panel during the presentation. If we have time at the end or during the presentation, we'll answer as many as we can. If we don't get to your questions, feel free to email us at info@marketplacerisk.com and we'll get your questions answered. And now, without further ado, I'll hand things over to our speakers.
Thanks, Andrea. And I'm happy to kind of kickstart the conversation. But first, want to thank Marketplace Risk for the opportunity to have this webinar today, and also want to thank Chris Moore, from Apollo for, I guess, candidly, his willingness to allow me to pepper him with several questions about all things occupational accident insurance. I, unfortunately, having some computer issues, my oldest son spilled some water on my computer this morning. So I will be just audio for this webinar, but by way of a quick introduction, I'm Joe Hurley from WTW. For those that may not know, WTW is a large multinational insurance broker, and within the firm, I lead up our sharing and gig economy practice globally. Been with the firm since 2019, and prior to joining WTW, spent just roughly 3.5 years working for Lyft, the rideshare company here in the U.S. As a risk manager, overseeing most of their corporate insurance. Been in the industry for about 12 years now. Prior to Lyft, spent some time as a risk manager for PG&E, large utility company here in the Bay Area, and also spent some time working for another large, multinational brokerage firm prior to that. Just quick kind of, overview of kind of what we're going to be focused on today. Look, many of these folks that have dialed in know that the digital economy platforms are really built on the backbone of its gig workforce. So with the recent prop legislation here in California, obviously the landscape is changing as regulators and platforms look to provide that additional protection for the gig economy workforce. So we will kind of dive into one of those protections that have been provided through Prop 22, which is occupational accident insurance, and we'll kind of talk through some of the benefits of that insurance and potentially ways that platforms are using that as a way to attract talent and obviously provide that extra security and peace of mind for its gig workforce. Chris, do you want to, before we kind of jump in with these questions, do you want to give a quick intro about yourself?
Yeah, sure. I can do a really quick intro. My name's Chris Moore. I'm the head of iBott, which stands for Insuring the Businesses of Tomorrow Today. It's a dedicated syndicate at Lloyd's, so we're an insurer. So it's our paper that we're insuring global tech and digital economy clients around the world. Managed by Apollo. We've been in this space since as early as 2013, and really just seen how it's evolved. And occupational accident, I think, is a great area where you've seen these platforms take on new elements of risk or try to find new solutions to help support their business, and a lot of that is to do with the sustainability of the gig economy and doing the right thing. So excited to speak to you, Joe, about this topic, and And I think it'd be great to have some questions as well from the audience if there's anything that we don't touch on in the course of this webinar.
Perfect. Well, let's jump in. And again, just for the benefit of the folks, we do not have any sort of prepared slide deck. I think we very much kind of view this as a fireside chat, for lack of a better term. I think this will sort of be conversational. We'll be kind of pinging each other with various questions throughout. So, Chris, my first one for you, maybe to level set for some of the folks that may not have much familiarity with occupational accident insurance. If you wouldn't mind maybe giving just a quick high-level overview of what that insurance sort of is intended to cover. And, for folks that might be calling in overseas, maybe if there's an equivalent over in Europe as well. But I think it'd be good for folks to have a foundation of the type of insurance that this utilizes.
Yeah, sure. So occupational accident, really where we've seen the majority of this from a mobility perspective has been in the legacy trucking owner-operator space in the United States. But essentially what we have within the gig economy space is you have these independent contractors who are not employees, and so they don't have the access to a workers' comp type benefit, or for outside the United States, they don't have access to an employer's liability type benefit. And so what the occupational accident is trying to do is give access to these independent contractors bought for by a platform as a group type policy, that if there's any form of accident where there's injuries caused by the accident during the course of them working as an independent contractor for that platform, that there's a right of recourse there. It differs so much in the product that it's not a set regulated in the same manner as employers' liability and workers' compensation. So there is a bit more flexibility with the underwriting and with the forms and with the coverage. So the benefits can actually vary depending on both the territory and both the client's buying parameters. And really the way it's purchased is very, very different. Because in many cases, and we'll talk about Prop 22, of course, because in many cases, this isn't something that a platform necessarily has to purchase from day one in certain territories. The reason that it's being purchased is again, going back to that trust thing that we talk about as the currency of the sharing economy. People are buying occupational accident type benefits to try and encourage more people to drive for their platform, to get a more trusted brand, to do the right thing, and ultimately hoping that that's going to enable growth for their platform. And so when you think about that, it's a real balance between the cost and the benefit in terms of the reward it will give you as a company. So what we see in the UK and what we see in Europe that differs, I suppose, to the United States is really about limits and it's about benefits. But the reason it's being purchased is pretty similar. It's to help with policy, it's to make the gig economy more sustainable, it's to build more trust and build more supply.
Got it. Makes sense. Thanks for that, Chris.
And I suppose I'll flip it back to you then, Joe. I mean, you mentioned in your intro that you've worked at Lyft and worked at Lyft at a really interesting time, right? Early days when legislation was still being shaped, right? The business was still, evolving into what it looks like today. Occupational accident, you will have seen at Lyft and, coming to the foray and Prop 22 and those early purchases of this coverage. And fair to say for the gig economy, the rideshare segment probably led the charge from occupational accident perspective. Can you give us an overview of Prop 22 and talk about what some of those early day conversations were surrounding OCAC? Yeah, no,
and yeah, it's a fair question. Kind of brings me back, or kind of brings me down memory lane a little bit. But yeah, look, there's always been this delicate balance of, I think these platforms like your Lyfts and your Ubers and your DoorDashes and Instacarts and sort of the list is endless. I think they're not ignorant or naive to the fact that really the backbone and really the engine that makes these platforms work is the gig worker. And so I think that they knew how valuable they were, but they also sort of on that same prism knew that there was this delicate balance of they knew that if those folks were converted into employees, that obviously significantly would have an impact on the business model. And some have indicated that their companies wouldn't be able to exist if that were to happen. So if you kind of go through specifically California, the backstory in terms of how and why Prop 22 was created, you know, it really was sort of formed due to a Assembly Bill 5, which is commonly referred to as AB 5, was passed back in 2019, which in short, and I won't sort of bore you with, you know, the fine details and some of the legal ramifications, but in short, California basically said, you know, we are requiring these platforms to reclassify these gig workers from traditional independent contractors to, in fact, employees. And obviously, you know, this was met with a ton of resistance from, you know, these large platform providers, as again, you know, their business models were just not designed to pick up the gig worker and consider them to be an employee. So, you know, Prop 22 was really initiated and pushed and funded, if you will, you know, by a lot of these well-known, you know, established platforms like Lyfts and Ubers and the DoorDashes, as a way to not ignore the fact that these drivers should receive some benefits, but try to find a middle ground in terms of realizing they need some benefits, but they can be afforded those benefits without actually being considered an employee from a labor or legal perspective. So long story short, November 2020, Prop 22 was on the general election ballot here in California, and it passed. And it basically overrode the prior AB 5 bill that was passed. Obviously, you know, a significant win for these platform companies. As these gig workers remained independent contractors, they remained having the flexibility of coming and going and driving or providing gig work when they wanted, how they wanted, where they wanted. But it also sort of committed these platforms to providing some quasi-level benefits to these gig workers, and one of those benefits is, in fact, you know, occupational accident insurance. So that's a little bit of the backstory. But Chris, you know, pivoting to how maybe you as an insurer, you know, have reacted and how you've kind of followed the, you know, the legal side of it, you know, here in California. I'm curious, just do you think, one, are you happy that Prop 22 passed? And, you know, do you think other states will ultimately follow suit with similar props or similar laws? And then also just curious, as you think about these platforms and a lot of them that you're insuring, you know, can these platforms potentially use OCAC or other quasi-employee benefits and give them to the gig workers? Can they use that as a way to differentiate themselves, you know, from competitors?
Wow, there's a lot to unpick there. The answer to the question of whether I was happy with Prop 22, absolutely. It was kind of strange, you know, it was obviously a big US election, and I was more interested in whether Prop 22 was to be passed than who was going to be the president. Obviously, I'm not in the United States.
You might be the only one who thought that.
Yeah,
but
maybe. Just shows how much of an insurance geek I am. But I was very happy with it. I think, you know, I'm a big believer in the gig economy. Otherwise, I wouldn't be at iBott. And I think it's the right thing to do. I think for the gig economy to be sustainable, you know, these people need access to certain benefits if something disastrous happens, and that is what insurance is there for. So at the true depths of my insurance heart, then yes, Prop 22 is a good thing in my opinion. I think the ramifications for it though are really interesting, and it will, I think it's now a really strategic sort of approach to that, and whatever other states follow with and other legislations around the US, around the world outside the US will follow with. So that's really interesting. I think the ramifications of if AB 5 would have passed would have not just changed the way that insurance looks for those companies, because it would, in many parts throughout the program, if you've got employees, you're really looking at a direct liability as opposed to a vicarious liability position. And we can dive deeper into that later in the webinar if you like. But also, you know, most most gig workers work for multiple platforms, and AB5 would have been very difficult to do that. So you'd have actually probably seen a lot less drivers or less giggers because, as a result, and just having people doing long shift work. You wouldn't need so many. I mean, I think most people's shifts are under 2 to 3 hours, so you don't have that 8-hour block. And part of the real attraction for a gig economy worker is the flexibility to do work whenever you like and wherever you like. So I think it would have been legislation that would have really had big ramifications, that would have taken away so many of the benefits to societal benefits of the gig economy. What Prop 22 has successfully done is found that sort of middle ground whereby, okay, the employee model is clearly not correct. And that, like I said, would have destroyed the gig economy in many ways. So we need to find this hybrid model that provides the protection we need, but also makes it economically viable for all parties. And I think that's something that can be replicated across the gig economy for other things and other walks of business. We're kind of in that jostle at the moment. When you look at the micromobility, the e-scooter space, insurance regulation is still being shaped by many of the cities in the States. And I think it's finding that ground of, okay, what's the right level of insurance that can still have the business to operate, that's cost effective and affordable, but is really achieving what we should. And I think that's where insurers need to do a lot more, working with their clients, working with regulators to help shape this regulation. Now, Prop 22, I know there was a huge amount invested from some of the major platforms. And overwhelmingly, I think it was a good job that those guys did, and it was great that it was passed. I think where there's still some work to be done is exactly what those benefits look like, and I think there's different platforms looking at different ways to do that, especially outside of California where there isn't the same shape regulation. And when you think about occupational accident in that sense, it's okay, I'm trying to create trust, I'm trying to help my policy team create good policies that protect our business, that keep people as ICs, because the full employee model would be very detrimental to their business. But I also want to use it to try and attract more supply. And what I mean by supply is giggers and drivers. Because for most of us, whether it's rideshare, whether it's delivery, time is of the essence for most of these. So if I'm waiting for one of my rideshare companies to pick me up, I'm probably not going to wait more than 4 to 5 minutes. The only way to keep that time low and keep it down is have more drivers. And so if attracting drivers is what brings the demand, then how do I do those drivers? Now, paying them more is an obvious one, but that's probably going to hurt you on a profitability perspective. The other one is to have those extra benefits they have. So if you have, platform A, you have these benefits, platform B, they don't, you'd like to think people are more inclined to work with platform A. And so you start then diving into, okay, what benefits are going to be impactful and meaningful for our giggers, for our ICs. And that can extend beyond OCAC, right? That can be maybe if it's a driving platform like rideshare or delivery, maybe it's providing them with free breakdown service, as well as all these other things, access to better repair shops at cheaper rates and things like this. Maybe it's providing them with, if you damage your mobile phone, we'll provide you with certain benefits to fix that quickly or replace your mobile phone. OCAC is a great one because it's obviously something that's helping a societal need. But for the most part, what we see is people buy it on an accident level basis. So you have to get into an accident. It needs to be a pretty significant injury. And it has to happen, obviously, during your work for that IC platform, for that platform as an IC. What we're starting to see, people have the conversation internally is, what is the cost benefit analysis if we now start thinking about things like sickness cover, right? Would that attract more drivers to our platform or more giggers to our platform? And if so, is the additional cost that we would pay for that level of coverage warranting, the improvements and the benefits to our business? And I think that's something that's really interesting. It's a fascinating part to be as an insurer, and I'm sure as a broker in this space, because you're really speaking about business development, you're speaking finance, you're speaking to the insurance is so embedded within the business. That it has huge knock-on effects, and you're really talking about insurance being a strategic USP for that company. And OCAC is a great example of that. And I think that's such a fascinating conversation to be having, and it's one we're having a lot at the moment.
Yeah, it's interesting. I'll piggyback a little bit. When Prop 22 passed, which ultimately now sort of required, for lack of a better term, that these platforms in California provide occupational accident plus a slew of other benefits that we're obviously not talking about here today. But I found it interesting. There was an initial thought that these platforms would really just initiate that benefit just locally here in California, and still in the other 49 states, if you will, would sort of continue status quo, where these folks would just be straight ICs. There would be no sort of employee quasi benefits provided. And it's interesting that what we're seeing, or at least what I'm seeing, is that these platforms are actually just extending that OCAC coverage to all of the states that they operate in. So, you don't have just the California folks that are, getting a perceived benefit that's greater than some of the other drivers. And I think, one would say, well, why do you do that? I think,
just to jump in there, do you think that is that purchasing, because they're not mandated to do that, right? Is that purchase from the platforms coming from because we're using it to attract more drivers, or do you think that's coming from this will prevent other states pushing something like an AB5?
Yeah, I think it's a little bit of, this is probably the right thing to do. And I think some of these platforms, have always tried to figure out, how do we give additional protection to these folks that basically are what make the platform exist. But they always, have this delicate balance of, we can't have these folks be considered employees while giving them this benefit. So that, like, from a legal perspective, there was always such a concern that, hey, we're just a platform, and we're providing you the ability to come on our platform when you choose, when you want, however many hours you want to work, where you want to work. And there was always like this sort of balance that we can't sort of overstep our bounds and sort of treat them as a traditional employee relationship. So I think there's just always some perceived risk with sort of openly providing the benefit. I think Prop 22 passing, which basically acknowledges that benefits will be provided, but from a legal perspective, they're still considered ICs. I think they, to your point, one, provided it to the other states, one, because I think it was the right thing to do. And two, I do think as a way to tell these other states, look, I don't necessarily think perceived legislation and other laws being enacted makes sense, because I think we're already starting to go down this path of giving these folks the peace of mind and extra protection that they need and warrant. So, I would say kudos to the platform for doing that. I obviously know it's not a, insurance is obviously not a profit center, so it's a loss center. And so there's obviously a cost to that eats into the unit economics of the business. So, I would just say kudos, for the platforms for really adopting this sort of nationwide here in the US. And I think candidly too, once a couple of them did it, Chris, I don't think you could have a competitor not offer it when one of their competitors does, right? Because then, to your point, if I'm someone that drives for various platforms and I know platform A, B, and C give me OCAC, but platform D doesn't, and I'm someone that really relies on that peace of mind for my family and other things, I might be inclined not to drive for platform D just because I'm not getting that additional protection. So I agree with you. I think Prop 22 was really the right thing to do, and I truly think it kind of met in the middle in terms of satisfying, the various groups that were opposed, to AB5, as well as folks that were, proponents of AB5. But I will say, kind of, if you pivot, right, I think me and you are very much fans of occupational accident insurance and fans of what the platforms have been doing. However, I think sometimes you may have unintended consequences, and I think this is this whole issue that these platforms were having from the get-go in terms of, if these folks are employees, how does that change how we think about our platform from a liability perspective, and maybe even a vicarious liability perspective. So, curious from your sense is, have you seen maybe a negative ripple effect as a result of OCAC, not related to OCAC, but potentially other non-OCAC sort of liability claims that are arising from the use of the platform?
Yeah, great question. Right, so to give some perspective on what we're talking about, so let me I suppose lay a bit of the land in terms of direct liability and vicarious liability, right? So if you own an asset, or if you have an employee that's as part of your business, it's going to be a direct liability if anything happens to that asset, or you're going to be directly responsible for the actions of that employee. When you have an independent contractor, you are not directly liable for the actions of that independent contractor, because, like I say, they are not an employee. You would have a vicarious liability linked to them, in terms of you have a duty as a platform to oversee them, make sure that they're safe and fit for purpose for doing the gig work that they are doing on your platform. But there are lots of protections surrounding that vicarious liability that obviously don't exist for direct liability. So permitting there's really good risk management in place, which for the most of my clients is absolutely true. There are huge amounts of defenses in that vicarious position versus a direct one. And that would obviously lower insurance costs, and really prevent these platforms from being liable for something that's almost, they can't control. So when you have an employee model, that's completely different. When you didn't have any legislation, and so there was no things like Prop 22, there's still a grey area of whether you're an independent contractor or a direct employee. And so a lot of plaintiffs' lawyers would have been attacking those platforms, saying, you are responsible, driver X has done this, or this task-based platform gigger has done Y, regardless if there's any negligence on your part as a platform, whether it was negligent hiring or negligent enrollment, whatever it was, you're liable because this has happened and it was the independent contractor was on your platform. Now that there's legislation being shaped, like Prop 22, to affirm that they're an independent contractor, it makes that vicarious liability defense a lot better. And so it's our duty as insurers to really protect our platforms, to say, there's a limit on how much we can be liable, right? And in most cases, what you're seeing the sophisticated platforms do, even from a liability perspective, so it's outside of occupational accident, is provide a limit. A primary limit is most typical of $1 million to these ICs. But beyond that, that's where you have that vicarious liability position. It's platform only type coverage, and that's where those big defenses come out. And that's really a partnership between insurer and insured about, right, how do we get our defenses? And that's most of what my team does, is really work on those defenses, speaking to legal, having our claims team really at front and center to try and shape that legislation. So the knock-on effects of that could be overwhelmingly positive if more people adopt things like Prop 22. It will make defending those types of claims, and it will protect from things like social inflation and nuclear verdicts, et cetera, et cetera. That's all underpinned by how good the risk management is, right? And again, you talk about kudos by an occupational accident. Some of the most sophisticated, best risk management that we've seen is coming out of the digital and sharing economy, because it's empowered by our smartphones. You can do things like telematics, and you can do things like risk-based routing, and you can do all these wonderful things from a risk management perspective to give more control, more insight, and avoid certain things, right? So telematics is a good example. We can find out which drivers are good drivers and optimize the amount that they're doing on the platform, find out who the bad drivers are, and either coach them through in-app coaching, things of that nature, or just removing and offboarding them. And that's before an accident has ever happened, right? So that's increasing safety within that industry. That is way ahead of some of the more traditional commercial fleet business that we have seen. So that's great that investment in risk management is happening, and that again is making that barrier for plaintiffs' lawyers to attack these platforms and try to get these big verdicts in court a lot harder. But there are things that we need to be really mindful of in both the OCAC space, the way you treat drivers, and the way you just operate your business in general, about understanding that difference between vicarious liability and direct liability. So a good example of this is, it's quite well known that the Lyft CEO will drive for Lyft on New Year's and do
New Year's Eve. Yeah, New Year's Eve. He's done it for like 10 straight years. Yeah.
Yeah, I mean, and it's amazing. It would be the disaster scenario for me if ever an accident ever happened in that particular Lyft, right? Not just because of who it is and the monetary sort of wealth of that person, but because they're a direct employee. And the program is not built for that. It's built for an IC model, and there's defenses and claim strategies and ways that the program is designed for that core business. It's not for that. And so, whilst it seems like the right thing to do, and it's a great piece of marketing and PR, from an insurance and risk perspective, it's a tough one, right? That's just a very isolated example, right? I've got no issues with them doing that. It's more working closely with business development. The skill of a risk manager at a platform, at one of these platforms, is really getting that business development to understand this is how our risk works, and under these different scenarios, under these different types of operations, this is what the impact can be to that risk. So any employee driving is obviously a very different risk to an IC driving. When we talk about risk-based routing, there's another case where you've got to be careful. If I am telling people where to go, which route to use, because this is the safest route, so classic avoiding certain roads or avoiding left-hand turns, things of this nature. If I am seen to be instructing someone, even under an IC gaze, that can be deemed you're instructing them, you tell them exactly what to do, and that can then say, this looks more like an employee model. And even if it isn't an employee model, because you've told that person to take this particular route, that is enough to create a direct liability. And so we've got to be really careful about this. So we can advise which routes to take, which is the safer routes, which would, and create incentives around that. But you've got to be careful on what you can actually tell someone to do, when you've got to keep thinking about, does this put more risk on my business? Because now it seems that I am responsible because of the way that I've instructed it. So a lot of these things, need to be really carefully thought through. In-app coaching is a big thing, right? Or when you get pinged to say, hey, there's another ride or there's another delivery, at what stage does that ping happen? Because if it happens at a stage in the app where it could be deemed to be distraction, again, this is another ploy that a plaintiff might use to correct that direct liability. So we're very versed to these. We obviously work with our platforms closely on them, but it's just understanding that. And I think some of the early days of OCAC was, if you're given this benefit, are you potentially putting yourself out there to create more liability? And rather than have this, we have just a tech platform that's connecting a worker to someone who wants the service, and so we can't be held responsible in a direct employee model. There's lots of things to think about, but hopefully that gives you a bit of color about what we're trying to do and how we're trying to educate platforms and work with platforms to create the best possible protections for their business.
Yeah, no, absolutely. And candidly, that sort of feedback you gave, we could spend the next 30 minutes specifically just talking about that and, drill down further in terms of, some of the, unintended consequences from a direct or vicarious liability on these platforms. I think we're at the halfway mark. I want to kind of get, through some of the rest of this stuff, Chris, and I do think, obviously we've spoke a lot kind of high level about, OCAC and, how that's a good thing, and Prop 22 and, how that all sort of came about. I think for the benefit of the folks on the line, it would be helpful maybe if we kind of got into the weeds a little bit from a straight insurer underwriting perspective. And maybe, what might be helpful, coming from you is, from a actual premium cost perspective, what can platforms be doing or focused on from a risk management perspective to lower, insurance costs related to OCAC? And obviously I know Apollo is very much a strong proponent on data and really using your data to help drive insurance costs. So it'd be, I'm keen to hear from you, in addition to just kind of broadly what folks can be doing to lower insurance costs. I'd also be interested to hear from you how important you think data is and how important it is for platforms to be utilizing that in an effort to manage their insurance costs.
So anyone who's dialed into this, who's known me or heard me speak before or does business with me, is probably rolling their eyes right now and saying, right, here he goes. Because it is so important for me, and I sound sometimes like I'm preaching when it comes to data, but our MO and the way that we operate as an insurer in this space is data-driven underwriting. What we have in this space is unbelievable amounts of data. It's not incredibly developed, so it's not long data, but it's really deep and really intrinsic. It's really granular, if you want. Part of being able to control and lower your insurance costs and get the benefits of all that risk management I'm talking about, all the controls that people are putting in place, is about being able to show that in your data. And so it's about having a data strategy that's really clear. It's also having a data strategy that's communicated and understood and worked on in partnership with your insurance partners. So it's collecting the right data, presenting that data in a format that bridges both exposure and claims, and going down to that granularity where it's going to have a meaningful impact. So whether that could be, very granular GPS type locations, right? So a lot of people will look at their exposures on a state level. Something performing in San Francisco is very different to if it's performing in Sacramento, if it's in LA, if it's in San Diego, right? All of those are very, very different areas of operation, and the risk associated with deliveries or rideshare in those different cities is very different. So you can actually go more granular and actually get lots of benefits than having just a statewide type rating. You then look at things like age factors. You can look at whether it's nighttime type operations versus daytime operations. You can look specifically at routes like we've talked about. Is it high speed driving on highways, or is it more suburban type driving on very low speed roads? Number of left-hand turns or difficult maneuvers. You can look at telematics of driver scores. There's endless opportunities of data to be able to give you all that ammunition to say, either it's to your business development team or it's to your insurers to say that this is how my risk is evolving. And then it's about you optimizing and controlling those to go, let's grow in the lower risk areas, because that's where our insurance costs can be lower, and hopefully that's where we get more margin. So it's things like that. It's empowering your business to make risk-based decisions based off that data. You're going to need that transparent relationship with your insurer so they can share with you exactly how their modeling works, exactly what things move the needle and in what sort of way, for you to be able to communicate that back into your business. But hopefully your insurer is willing to do that, because what you're really trying to do is create a more sustainable program, a pricing that works for all parties. And the more granular you can go, the more accurate I think the pricing could be. And so you're not going to get these jumps and spikes on both ways, good performance and bad performance. So that data is absolutely key. But the data then is really telling you what's happening. And then it's really about what you're going to do with that data and how you're going to control it. And that's where I think some of the optimization that some companies are doing and some companies in the future will be the real differentiator for platforms. And whether that's passed on to the consumer or not, it is a different conversation. But is there a way that I can optimize, or just stop certain deliveries if they are, or certain rides or certain tasks if they are too risky? So whether it's trust scores that you might have with certain ICs, and those trust scores mean they can only do certain types of gig work. So maybe if somebody doesn't have a very good trust score, and that's built on their performance, that's built on lots of different characteristics, then they can't access the really riskier trips. Or if it's the best possible drivers or the best possible giggers, they are the first port of call to access as many trips as possible. So you get more people doing those and getting remunerated for, incentivized to do it. So if you can create a culture that people want to be better with their risk and be better and safer operators, again, that's going to lower insurance costs. So I think with that data, it empowers risk management teams to do lots of amazing things to improve themselves and better their pool of exposures. But there's no, one doesn't work without the other. There's no point having all the data and having all these insights and doing nothing with it. And then there's no point having all this great risk management if you don't know where to focus your efforts, because you haven't got the data telling you where your pain points are and where you're going.
Yeah, no, it's interesting. And I think we're starting to see some of the larger platforms do this, where you have really granular pricing down at the state or the city level. But, hearing you talk, it seems like where you ultimately want to get, Chris, is really having your clients or insureds use data to really get granular in terms of no longer having sort of a blanket rate, that you guys are looking at all of their operations. And to your point, you're saying, man, they're heavy in Florida, and Florida is problematic for a variety of reasons, and they're heavy in New York. And so, but they're 95% of their risk is in cities or states that we actually find favorable from a litigious environment. But however, those are getting penalized from sort of the bad states or the bad actors, right? So I think what I'm hearing you say is you'd love to get to a point, and I think you're doing this with some of your clients, where you say, all right, San Francisco, and whether you're a micromobility company, car share, ride share, has a set rate or a dedicated rate. And that's going to be different than Los Angeles. That's going to be different than Austin, Texas. And you truly are underwriting based on the actual risk, as opposed to sort of just applying a blanket rate where you have some, concerns with sort of territories they're in, and it's actually penalizing the client from a holistic perspective. And without that data, you will continue to price that way. And so the data really gives you the comfort and the flexibility to drill down and provide specific pricing based on a particular region or geography. Is that safe to say?
Yeah, completely correct. I think, I hear often I hear the phrase, we want something simple, really simplified rated program. And the problem you have with that is that you're always going to have a winner and loser. And it doesn't matter whether I'm a winner or loser, the likelihood is that that account and that partnership for me is going to be under pressure. And it's not going to be long term, and that's really what I'm here for, is long-term partnerships. Long-term partnerships are sustainable, and there should be a mutually beneficial, outcome for both parties. And that typically is you're doing pretty well. Both of you are doing pretty well, right? If anyone's underwater, then the partnership's probably going to come to an end. And so when I go to a simplified rating, depending on how the companies evolve, and we all know that platforms in the digital economy can completely transform themselves or explode into massive exponential growth overnight. And so when that happens, if you have a simplified program, typically it's really uncertain, and you can have really unfavorable outcomes both ways. So, just a random example of this would be if I've, written a new delivery platform, and they have a niche form of operation, they're delivering a very niche product, and they're going to do so nationwide. I assume that they are in, whatever the percentages of different states, and I provide a rate on a single, just a per delivery rate on a nationwide basis. If, like you say, they massively grow in Florida and California, and that's 50% each of the exposure, and they've got nothing in some of the more innocuous states, I've probably underrated the business and due to lose money, in which case I'm going to have to do some correction at renewal, puts pressure on the relationship. Likewise, if they actually only operate in the innocuous states, there's nothing that I expected in California, and there's nothing I expected in Florida, but yeah, I'd made a 25% allocation in both states. All of a sudden, my rate looks way higher than maybe it could have been, and all of a sudden, my client feels like they've overpaid for insurance, and then there's pressure, and then they're looking for a different relationship. So I think it's detrimental to both parties not to do that engagement on data and that granularity, because really what you want is a really is a fair and equitable rated program that everyone knows what it's built on. And if then there's changes to the exposure base because the company's gone a different direction, then hopefully there's no surprises. That they say, well, you've grown in this area. We always told you that area was higher risk, and you knew that there was a higher rate involved with that. And so as long as that's been communicated with the wider team within your business, there should be no issues. There's nothing broken with your insurance program. And what this has actually led us to do as a business within Apollo is hire a lot more actuaries and a lot more data scientists, and actually building tools internally and building ways that we can have a more regular engagement with our clients. So rather than wait till this classic 12-month cadence of renewals and say, hey, by the way, you grew here and you grew there, and they're really high risk or really low risk, so there's going to be a big impact, and your insurance ratings look very different from last year, which can cause pain and headaches and surprises, and nobody likes surprises in business. Well, no one likes bad surprises. Actually, if I have a more regular cadence and I have a more engaged sharing of data and sharing information, I can say, look, the way that you're trending, all of this looks favorable and really positive, and you should expect rating to be, this percentage difference at renewal. Let's keep monitoring, keep talking. But at the moment, everything looks, everything looks good, or the growth is as expected. Conversely, you could say, hey, we're spotting this trend. What's happening with the business? Do we need to have a think mid-term about whether this insurance program is still fit for purpose, given where you're growing, or given the size of growth, or given the types of exposure you're doing? So this regular contact for me means that your insurance program, if done well, should be more fit for purpose and meet the needs of your risk much better. So whilst I might be seen as this data vampire, just send me more data, there is a reason why we want it, and most of it is to be offering better products and better services and better rating to our clients. And occupational accident is a great example of that. It's so territory specific, and it can be so impacted by risk management controls. And so if we see those trends within the data, we want to react early and make sure that we're constantly evolving the product so that it's, like I say, fit for purpose.
Yeah, that's great. I'll just, I will tell you, I think kudos to you guys. I mean, obviously insurers, in addition to yourselves, have really started to kind of get into this notion of usage-based pricing. I know you guys for years now really fundamentally thought that's where the industry was going, and I think especially specific to auto, as well as maybe even some of the micromobility space, that is where the industry has gone. So kudos to you guys, obviously kind of pioneering or kind of being at the forefront of some of that. I'm looking at time here. We have 14 minutes. I had a couple other questions here. We've kind of, I think, addressed some of those, Chris, just kind of through this conversation. So maybe my last question to you, and this is kind of, I think, an issue that we're seeing with the platforms. I saw it from my time at Lyft, in terms of just when you have such a sheer amount of volume in terms of folks coming and going off these platforms. Unfortunately, there is, opportunities for fraud, where someone might be aware that there's occupational accident insurance. They're driving to the store, they get in the accident, they flip the app on and say, "Hey, platform A, I was in an accident and I was injured. I'm afforded occupational accident insurance." So, just from an insurer perspective, what's your thought on fraud and other sort of similar related issues? Anything that platforms, from your perspective, can be doing to potentially mitigate the fraud? And I guess maybe lastly, are you in fact seeing a lot of fraud, as it relates to potentially some of the claims that are coming in?
Yeah, great question. I think before I tackle the sort of fraud element to it, I think what's really important is what's amazing about this digital economy, and what's amazing about being an insurer or an insurance broker or just a risk manager and insurance professional within it, is that there is scope for real innovation. I've seen some amazing products from our business, from outside our business, from some of my competitors, fantastic products, and really innovative and getting to the source of real problems and creating great solutions. But one thing you have to remember with any new solution, if it's an insurance solution that you are going to use to build trust, so you're going to advertise and market the existence of it, because otherwise, why buy it, why purchase it? You have to think about, the Kevin Costner film Field of Dreams, right? If you build it, they will come. The claims will come if you build a program, you market and you advertise it. Well, that's fraud or non-fraud. Claims will ultimately follow. And that's just because of the knowledge of there being an insurance program. If you didn't know the insurance program was, you wouldn't be necessarily making a claim because you didn't know it was there. Once it's been put there and you know it's there, it can trigger more claims, and some of that can lead to fraudulent claims, people trying to take advantage of things. Now, there are ways to structure products to eliminate fraud. Classic use of deductibles, classic use of making sure that you have really good GPS data to make sure the person is who they say they were, and they were working on the platform at the time they were working on the platform, all these different things. So there's absolutely risk management there to really make sure a claim is valid. But when you're looking at those new programs, some of the hardest part is using data historically to try and build that pricing model for what that new product looks like. Because of that, you're going to get an increased frequency of claims because it's a new product, and when people didn't know about it, they're ultimately not going to claim. So that's one thing to keep in mind as a platform when you build things. Some insurers, you might say, well, I don't understand where this rating's coming from. What's your concern? One of the concerns will be, an increase in claims frequency because of the presence of the product. That's definitely something in occupational accident you have to be aware of. If you're looking at, okay, well, we didn't receive, very little. We had very little claims before the product existed. That doesn't really hold much weight because, well, obviously you didn't get because the product wasn't there. It's a bit of a catch-22. But what you can look at, which is amazing with some platforms, is if they have telematics and if they have crash detection software within their application, then you can start looking and go, these are the number of incidents we had. These are the, the number of incidents we know that the driver was injured. We can then take an assumption on what the severity of that injury was and then back that into, an occupational accident type model that can give us a degree of this is what the rating would look like. So in some of the early days, that's how you can build new products and think about how to price things. But of course, fraud is a big one. Now, there are obviously fraud screening things that insurers can do to find out bad actors. And I think there's lots of things that we can do better. Maybe there are more collaboration that we can create. I know that companies within the digital economy, sharing economy are fiercely competitive, but I think for the right sort of causes, that's changing. You look at the Lyft and Uber collaboration on sexual incidents involving ICs. Fantastic, kudos to them. That's absolutely something that needed to happen. I think there can be more in that space to eliminate bad actors, to eliminate fraudulent activity that would be overwhelmingly impactful for everyone involved. It's not really a unique selling point for any individual company. That would benefit the industry as a whole. But most of me, for the most part, if I'm going to partner with a client, I need to see an element of risk management to control things like fraud. And a lot of that comes from, what do they have within the app? They're aware of it and they structure the product correctly to make the barrier. You're never going to eliminate it completely, unfortunately, but just to make the barrier so high that it's not going to be something that's so detrimental that destroys the sustainability of the product.
Makes sense. And, I agree. I think it's a little bit of a dual partnership. I think there are a lot of great things these platforms are doing. Inevitably, I think you still inherently, because of just the sheer volume, do have bad actors. You have folks that figure out ways to beat the system. But I think, collaboration with the insurers who ultimately are sort of analyzing these claims, I think collaboration between the platform and the insurer, I think at minimum can at least help move the needle in terms of trying to discover these claims, deny them, and ultimately try to get rid of some of these bad actors. So, I think that makes total sense. We got 8 minutes left. That is all, Chris, in terms of questions I had for you. I will just again want to thank you for the time. You've grown up quite a bit in this space. We go back from the early Lyft days, and you were obviously instrumental, even kind of prior to Lyft and Uber becoming household names. So, awesome for you and the team you've built out, and I think for the folks that joined, I hope they found some of your insights informative and beneficial as they think about potentially their own business and potential of occupational accident insurance. So,
yeah, thanks, John. The iBott team will be at the conference in San Francisco as we always do, and we'll be attending London as well. So anyone on the call wants to speak to the team, please reach out to us either through Joe or directly or through the marketplace risk guys. But like I said earlier, what I find amazing is just the level of innovation coming out here. I think it's almost unparalleled for some of the insurance industry. There's so much innovation going on in this space for marketplace platforms and risks. It's fantastic. An occupational accident born out of something. I think it was really, it was an innovative. It was almost a legacy product that had a really innovative application. And I think there'll be more of those types of things that will come. And those are the sort of things that I just love to chat about, whether we can support or not. But certainly always willing to join a call or have a conversation about a new product, especially if it's solving a real problem, and it's been focused with a client-centric attitude. They're great things to collaborate.
Well, amen to that. And again, thank you. And Andrea, we'll turn it back over to you.
Thank you so much. And I think we actually have time for a question. Does that work for you guys?
Sure.
Perfect. So someone submitted, can you elaborate more on the difference on limits and benefits between UK and US? Does UK provide more or less? And if so, what are those?
Yeah,
Chris,
sure.
I'll refer to you on that one.
Yeah, sure. Again, it's very specific, I would say, and specific in the form of it depends on what the platform's buying appetite is. Typically, you wouldn't necessarily see much higher limits. We have a very different health system, as you can imagine, in the UK versus the United States. I'm certainly not going to get into that on this call, and wouldn't have anywhere near the amount of time. What I am seeing more, we don't see typically the breadth of coverage being asked for in the United States. That may be a cost impact, that cost thing from an insurance perspective. But what we certainly are seeing is broader requests, like I said, for sickness cover and other things like that in the UK and in wider Europe, that we're not seeing those type of requests in the United States. You've also got, I suppose, workers' contracts, a lot more closely to occupational accident. And so what you kind of have is there's kind of a written playbook, and then there's kind of like your second cousin. Very different product, but it's kind of, it dovetails. Employer's liability looks very, very different to occupational accident in the UK and Europe. It tends to be a large limit. It doesn't have specific limits by injury or anything like that. So occupational accident looks and feels very different in the UK and Europe versus your standard employee's liability.
Okay, amazing. Maybe we have time for one more. Does the platform always pay the OCC, ACC premiums, or are the premium costs passed on to the ICs?
Joe, I can answer this, or I'm sure you have some views as well. I think for the
Go ahead, Chris.
Yeah, sure. For the most part, we see the platforms purchasing this as a strategic purchase, like I said, to try and encourage drivers onto their platform. I think in some lesser developed places or lesser developed markets, you're seeing it offered as an additional benefit if you want it. We call them opt-in programs. You tend to get a low level of traction, in my experience, with opt-in programs. It still creates, defenses from a liability platform perspective, because you can say, well, I offered the benefit, so I kind of made it clear that I wasn't giving one. I was making sure that they're definitely an IC, but with a low level of traction, it doesn't hold weight with the policy teams, I think, or with regulators to say that most of your drivers have the benefit, and so we're not going to create legislation like AB5. So it doesn't solve that type of problem. And if there's low penetration, it doesn't solve many other types of problems. So there's those two things there. And really that comes from most people don't do anything like thinking, well, wait a minute, what happens if I break this or I get severely injured here? Am I definitely got insurance? Even I, as an insurance professional, that's not the way my brain works. I don't think about insurance with every single thing I do. And that's why you don't get that take-up rate. People think they're invincible for most part. And so, yeah, low level of traction means that you don't even, it's tough to buy, I would say, opt-in programs now, because insurers have seen that low level of traction, done a huge amount of work to create a policy, and then bound very little. So a lot of insurers, most of the cases, iBott included, would not be interested in talking about an opt-in program. Joe, is that consistent with what you've seen at WTW?
Yeah, absolutely. And I think we saw that a little bit prior to Prop 22. Some platforms did initiate some opt-in stuff, and I think when the drivers looked at it, obviously them purchasing it would go against or reduce their earnings. And I think, to your point, they looked at that and said, well, I'm invincible, nothing's going to happen to me. I want to keep my 5 cents per ride or whatever it is, or per mile, and pocket that. And so we to your point, very low utilization rate. And since then, I think obviously with Prop 22 and other things, I think you're just seeing these platforms outright buy it. Now, they may pass on the cost of folks like me and you that use the service, right? But ultimately, they are sort of paying the premium with the insurer.
And to your point earlier, if one platform is giving it to you as a free benefit for what it seems like, and then another platform saying you can buy it, then all of a sudden, you really,
those are drastically two different messages. One, to me, says we really don't care as much about our drivers as you might think we do.
Exactly. I think when one platform in a territory is providing it as a benefit, then if you want to be a serious competitor to that platform, you're probably going to have your hand forced into doing something similar.
Totally agree.
Well, thank you so much. Do you have any final comments before I close this out?
No, just thank you very much.
Yeah, thanks for the time. Appreciate it, Andrew.
Looking forward to the conference later this month.
Thank you. And we're very excited to have you guys there. And thank you everyone for joining us today. As a reminder, check out marketplacerisk.com to access this recording along with hundreds of hours of content and to subscribe to our email newsletter to stay up to date on all events. Thank you everyone for joining us and have a great day.
Thank you.